Hi, everybody. Welcome to the series of videos where we are discussing a very important concept of cost of capital. And I'm hoping that you have already seen and attended the class on the initial and introductory video where we understand the concept of capital as such. Why do we need money? And what are the different forms in which a business can raise money? In the video, we have discussed that there are broadly two forms: pure equity and pure debt. And then we also had a quick discussion on a gray matter between the pure white and a pure black in terms of preference shares. Now, in this video, I want to take a deeper dive into the concept of debt capital. Why do you think I chose to talk about debt capital? Loans are a part of our lives ever since. It's nothing new. But as a matter of fact, loans are not the only way a company or a government or an individual can raise debt. And that's why I thought that it's a good idea to bring everybody at the same page by introducing another fantastic instrument within the whole spectrum of debt capital. Now, I'm going to deep dive very shortly, but don't forget that whatever we are going to talk about is going to be part of broad debt capital only. So don't forget that the investor of this capital, which are sometimes called as a lender, sometimes called as a bondholder, sometimes called with different names, is not really interested in success or failure of the business to whom the money is being lent to. They're only worried about the safety of their capital. So the success that they're hoping for is only to the extent that their money is recovered well. Beyond that, the fortunes are not tied up at all. The borrower also, for a debt capital, is really not interested to make the investor a part of their life. Therefore, sometimes we refer to debt capital as an outsider's capital. That these are the people who are not really ours. Okay, so imagine a very distant relative that you may have, who only a Holi or a Diwali or a Happy New Year greeting is the only relation that they have. What happens to you is really not their concern. Doesn't matter what they say and what they show as emotion. That's a debt capital for you. So there is some linkages that you have, but they are not really the intrinsic, the core, the heart and soul kind of a linkage. So that's what a debt capital to you. So allow me to take a deeper dive into one of the fantastic instruments called as a bond. Now, this has nothing to do with James Bond. Okay, um, bond is the second most famous instrument within the whole spectrum of debt capital. The first one, of course, being something called as a loan, which all of us have been a part of. Okay, so allow me to scribble a bit. Yeah, so here I am with loan, most famous, and now we are going to talk about something called as a bond. Now, perhaps, many of you must be looking at a bond certificate for the first time. So why don't you take a pause at the video and take a good look at what is there on the screen. Once you have done that, the discussion is going to make more sense. Okay, just take a 10-second pause and read through what is written, and then we will start the discussion. So I hope now that you are now much well versed, and allow me to pick up a few features of this bond certificate. Now, it's actually a relationship between somebody who has the money and somebody who needs that money. So some terms of borrowing is mentioned on this whole certificate. So the first term is the fellow who is issuing this bond, which means the borrower. Remember, I said that the bond can be, or a debt in general, can be taken by a company, a government, and also an individual. So anybody who has some creditworthiness can actually borrow. So in this case, it's been borrowed by one of the governments of Australia. Okay. Then the name also reads as treasury bond. So treasury generally refers to the government. Okay. In this case, the second feature of this bond is the face value, also sometimes called as the par value, although the two things are different. And this is again something which is a little confusing and therefore worthwhile discussing here. Now, when you look at this bond, there is a number which is appearing on the face of the instrument. That number is the face value. The name itself says that this is the face value because it's on the face of it. Every currency note has a face value. Every stamp paper has a face value. Every legal document, in every country has a face value, which for this bond is a $20. Now, the role of a face value is to provide a very stable base to calculate the rate of interest and any other periodic income that the borrower may have to pay to the lender. So that's one of the important part. Why can't this periodic income be based on the market value? Well, very simple, because market value keeps on changing. So every year, every minute, every second, if something is listed, so therefore it's very difficult to take which moments market value should we take, because then it will be contestable. So therefore face value is something which is printed, is never going to change. So that's one of the role of face value. The second role of a face value, which again is 20 in this case, is to pay the stamp duty, some government charges, etc. Whenever you are taking this legal action of raising money from people. So therefore, you need to pay, for example, when you get your properties registered, you need to pay a stamp duty. The stamp duty is on the base. So stamp duty is a percentage, let's say 5% on something. So that something has to be very stable base. That's again is your face value. So face value has two broad roles. Okay. But this may not exactly be the amount that the borrower will return to the lender. Sometimes that amount may be higher than the original. So in this case, it's perhaps the same. But sometimes imagine A is the borrower and P is the lender. A is very desperate to borrow, and P understands this whole thing. So P may negotiate very hard and strict terms. So P might say that, hey, here is your $20 that I am giving to you, but upon return, in addition to some periodic income, I want you to return $21. So you see, this becomes the redemption value. It again depends upon the desperation between the borrower and the lender. Of course, a counter argument of this whole thing is that A and P could have argued and agreed upon the following terms: that the return will happen of $20 only. Perhaps P will not lend full 20, P will lend a little lower amount. So this kind of an arrangement is where a discount is being provided at the time of issue, makes this a discount issue. In this context of bond, we call this a discount bond. Okay. There could also be a situation where A is more powerful and P is a weaker candidate. So A is perhaps a company such as an Apple, where they have very strong creditworthiness, and P is a normal or a very small investor. So A may dictate a term, says that in case you want me to repay $20 at maturity, you'll have to give me $21. Of course, now these two numbers that I'm writing are the capital values. Over and above that is going to be a coupon interest, the periodic interest, the interest component, the return component, as we spoke about in the time value of money. So this is just the original principle that we're referring to. So if this is your par value and this is your something called as the issue price, the price at which the bond is issued, or which means the price that the investor will have to pay, this bond is called as a premium bond. Obviously, a premium bond is more expensive to buy for the investor. It is advantageous to the borrower. So these are the nuances that we are going to discuss in the class, okay? So on and so forth. So take a good look again, back to the image. So first is your issuer, who is borrowing. Second is the par value, how much will be returned, and it is very closely related to face value as well. 99% times the par value is same as the face value, unless it's a discount or a premium bond. The next thing is how much is going to be the periodic interest that will be paid over and above the principal. So that number is also mentioned here. You see, in case of debt capital, as we were discussing in one of the earlier videos, equity is very uncertain from an investor standpoint, but the debt is very fixed and certain. Therefore, sometimes also called as a fixed income instrument. There's the income of an investor is fixed. I know there is a committed rate of 5.25% in this case, which means that the borrower has promised to pay 5.25% every year on what amount? On $20. So how much is that going to be? A $20 into 5.25% is going to be a 1.05. Okay, now 1.05, don't forget it's per annum. Okay, if you read the fine print here, 5 and 1/4, which means 0.25. Okay, rate secured percent per annum is what I wanted to say. So the coupon per annum is $1.05. But sometimes the bond lender and the borrower might agree that I don't want per annum cash flow. I want a half yearly cash flow. We call it semi-annual. Okay, in some cases, we just write it as SA. Sometimes it may be quarterly, but semi-annual internationally is the most prevalent, in which case my coupon, which was 1.05, is going to become a 0.525. Okay, so you see these small portions being mentioned here. This is the name called as a coupon, where remember your school times where sometimes there used to be a school fete and we used to distribute the tickets. The tickets also called as a coupon. It used to be a perforated kind of a paper where you could tear it off from the main booklet. That's how these coupons have got the name as a coupon. Okay, so you see the amount here 0.52. Oh, I thought it was 0.25. The next coupon is 0.53. Oh, that means rather than giving the money in cents because of a round of hard cash problem, the company, my bad, the borrower, which is a country here, have agreed that in one instance I'll pay 0.52, and then in next instance I'll pay 0.53. The annual, therefore, is going to become a 1.05. That's exactly what's the agreed upon, confirmed rate, fixed income to the investor. Okay, so the name, now you know how have you got this name as coupon. Today, I'm sure it's very difficult to connect because everything is dematerialized. When you subscribe to the bonds of, let's say, Muthoot Finance, you don't get any such certificate. All you get is an email. There is no hard copy coupons that you get. All you get is intimation over an SMS or a WhatsApp or an email that, this is the amount that is due for 6 months. The amount is being credited to your bank account. But good olden days were not as simple as that. It was very laborious in a way. So a hard copy certificate would come to the investor, and then the investor will have to take this coupon and then go to the head office of the company, the issuer. If it's government, then the government. If it's individual, then the individual. And then they have to present that. Upon receipt of that chit, the coupon, the company will pay or the borrower will pay 0.52 or 0.53. So that used to be the time, and you can see that, it's been quite an evolution since then. So these are the three main important, okay, four main important things. The fifth more important thing is, when does the investor get the money back? So like a fixed income, like we know the debt as a basic characteristic, there is a promise to repay the money. Now, it's not enough just to say that I'm going to repay your money. I promise. But what is also important is to pick up a date on that, as to what is a date on which the redemption has to be made. Because only after that date, the the investor can complain to the court of law, and then let's say a bankruptcy proceeding can be initiated. So till that date, the promise is due. So this date is 15th November 1987 in this case. So as you can see, the instruction here, or the summary detail here, clearly specify that it's a 5.25% coupon repayable on 15th November of 1987. What is the date on which it has been printed and issued? February 1966. So 66 is also the full year. So you can imagine it's almost like a 22-year-old. 22 year is the total duration of this borrowing. Okay. And if semi-annual is what you're paying, then you can imagine there will be 44 coupons. Okay. So 22 into 2, every year you get 2 coupons. So you see here the numbers 41, 42, 43, and 44. So these must be the last 4 coupons that the company decided to print here. I'm sure the first 40 coupons would also be given to the investor on a separate page. Okay, but like I said, okay, remember that these days there is no such coupon as a hard copy that comes up, and so on and so forth. So what we discussed, just a quick price. The issue price is the amount that the investor is going to, give to the borrower. Um, so issue price, if let's say is more than the par, it becomes a premium bond. If it's less than the par, becomes the discount bond. Face value is something is on the face of it. In some instances, it's also the redemption value. Uh, in case of an instrument called as a loan, it is always the same. Face value is the par value. But in case of a bond, it may be exceptional, and some bonds are redeemable at a premium. Okay, so face value is something which is written on it, the basic denomination of that instrument. Two roles. First, to pay the periodic interest, 5.25% of what? Of face value. And second, any government duty needs to be paid. Term in our case was 22 years. Bonds are raised, let's say, between 1 year to 30 years, very long term borrowings. Okay. And in the life class, we are also going to talk about some very interesting concepts such as irredeemable bond, inflation index bonds, mortgage backed securities, floating rate bonds. So these are all innovations that have happened into this arena called as a debt instrument, into the arena called as a bond as an instrument, between the borrower and a lender, driven by some contextual requirement. Okay, and we are going to talk more about it when we meet in the live class. Next thing was a coupon, which was a 5.25%. This is a periodic interest, and the frequency of payment could be any as agreed upon by the borrower and the investor. Generally, for bonds, it's semi-annual. Okay, but you don't learn that as a hard rule. Look at a question, look at an interview case study, and then note that point very carefully. Par value is a redemption value, which generally is the face value, but as we discussed, could be different as well. This is where your calculations are going to come in. What is the effective cost of debt? And for that, we need a separate session. I want to quickly close this by showing you another bond instrument, again, very dated, American Airlines Incorporation. I just want to highlight one small point, which is this. You see, different features got added. Like I was saying, we're going to talk about some interesting things when we go into the class. One of them is something called as a convertible bond. So a bond without any such hi-fi fancy features is called as a plain vanilla bond. With all of that, could be a convertible bond, there could be a compulsory, conversion option, there could be a callable bond, there could be a puttable bond, there could be an inflation index, like I was saying. So very exciting, class on the bond, which is about to come. And I can't wait to see you in those live classes. So in this case, you can see that there is a subordinated, which means the debt that you're being issued by the American Airlines, this is a corporate, so it's a corporate bond. The company is telling the investor upfront, nothing to be hide, that this bond is not a senior debt, but a subordinate debt. That should there be a winding up of the company, then you're going to stand much later in the queue, which means your risk is higher. It could have been a senior debenture as well. So you see, different instruments. We said loan, we said bond, we said notes, we said debentures. Debenture is another instrument within the whole arena of a debt. Okay, and as you become much more deeper into the whole concept of corporate finance, you're going to learn about these instruments in a much, much, much better format, right? So can't wait to meet you in the live classes. That's it about bonds as an initial precursor. Thanks very much.